Welcome to today's Daily Brief. Let's cut right through the noise of this recent market panic. We're also going to investigate a massive central bank policy error that completely flew under the radar. This explainer is all about trusting the raw numbers over those flashy headlines, so let's just dive right in.
You've probably seen the headlines screaming about a sharp drop in major tech and semiconductor stocks, right? It's incredibly easy to panic when you see that. But let's take a collective deep breath. Let's look at what the data is actually telling us. Because despite those dramatic intraday drops you're hearing about, crucial support zones were never actually broken.
Section 1. Market breadth over big tech.
So, the prevailing narrative lately is that this entire market rally relies on just a handful of tech giants. People think if tech falls, the whole house of cards comes tumbling down. But let's look under the hood using a metric that rarely lies: market breadth. While those heavily weighted, big-name tech sectors were undeniably dragging down the major headline indices, the equal-weight S&P 500 actually closed higher. Think about that for a second. That index treats the smallest company exactly the same as the largest trillion-dollar behemoth, and it went up.
This clearly illustrates that the broader market foundation is actually holding incredibly strong. What we're witnessing here is not some systemic crash. No, it's a very healthy, very normal rotation of capital. The money isn't fleeing the stock market, it's just moving from overextended tech names into other sectors. From a structural standpoint, this is exactly what you want to see if you're looking for a sustainable uptrend.
Section 2. The contrarian bullish signal.
Okay, so if the market's foundation is so healthy and broad-based, why does everyone feel so incredibly pessimistic right now? Well, the disconnect between market reality and investor emotion is exactly where the real opportunities hide out. Consider the recent AAI sentiment survey, which reveals a really stark reality about retail investor psychology. Suddenly, over 42% of surveyed investors are bearish. They are literally bracing for a crash. Meanwhile, the bullish camp has completely collapsed from previous highs, dropping down to just 31%. The crowd has gotten aggressively fearful, and it happened fast.
Let's dive into this concept for a minute because it is absolutely vital for navigating volatile periods. In financial markets, extreme public fear is often a powerful contrarian signal. When everyone rushes to one side of the boat, in this case, the bearish side, the market tends to do the exact opposite. This extreme bearish sentiment strongly suggests that the near-term outlook, especially for July, might actually be highly bullish. The crowd has already priced in the absolute worst.
Section 3. Anticipating the real correction. Now wait a minute. Being near-term bullish doesn't mean stocks are going to go up in a straight line forever. Actually, scratch that. A true structural market correction of at least 15 to 20% is absolutely coming eventually. But successful investing is all about timing, right? It's about not jumping at shadows before the real catalyst arrives. The current underlying data, that strong market breadth and the overly pessimistic sentiment, strongly suggests that this major drop will be delayed. It is not happening right now.
Section 4. The ECB rate hike.
Let's pivot over to macroeconomics for a second and look at a highly questionable move by one of the world's most powerful institutions, the European Central Bank. This is a classic case of what happens when authorities stop looking at real-time data. The timeline here is honestly stunning. On June 11th, the ECB unanimously voted to hike interest rates by 25 basis points. Unanimously. And they did this on the exact same day that global oil markets were flashing a massive, glaring signal that inflationary pressures were actually reversing.
Section 5. Oil prices tell another story.
When the ECB released their statements, they justified their rate hike by citing rising energy prices from May, basically arguing that inflation expectations were becoming unanchored. But real-time energy markets, which trade every single second of the day, told a completely different story. This brilliantly illustrates the massive disconnect between bureaucratic decisions and market reality. While the ECB claimed inflation was unanchored, the oil futures market was clearly in backwardation. That simply means market participants were actively pricing in lower oil prices in the future. Plus, actual data showed that one-year inflation expectations were already falling from April into May. The core premise for their rate hike was demonstrably false in real time.
In fact, if the army of economists at the ECB had just pulled up a basic technical chart, they would have clearly seen Brent crude falling decisively below its 50-day exponential moving average. For anyone in the trading world, you know that is a decidedly bearish signal for the asset and consequently a bearish signal for future energy inflation. The market was literally screaming that prices were dropping, yet they hiked rates anyway.
Section 6. Navigating an opaque market.
Making a policy error based on lagging, backwards-looking data is one thing. It happens. But how central banks handle and defend that error after the fact, that is what really matters for everyday investors trying to navigate the economy. Just recently at an ECB forum in Portugal, the Bundesbank governor was pressed on this glaring data discrepancy. Instead of admitting the real-time data had shifted, he defended the hike by weakly calling the market opaque and noting that wage negotiations can last 50 days. It was a stunning refusal to acknowledge the basic charts right in front of him.
Let's be real. Calling the market opaque is an absurd defense. The data wasn't opaque, they just weren't looking at it. By ignoring real-time oil backwardation and missing a steep 25% drop in oil prices that happened right under their noses, they pushed through a rate hike that unnecessarily damaged an already cyclically fragile European economy. It is just a textbook example of institutional pride overriding objective data. Ultimately, this explainer proves a harsh but necessary reality. You absolutely must trust the raw data over institutional rhetoric. If the people pulling the economic levers refuse to read the charts and prefer to rely on lagging statistics, it is entirely up to you to navigate the reality of the markets. So I'll leave you with this to think about. If the world's major central banks are making unanimous decisions while ignoring real-time indicators, are you making sure your own portfolio is grounded in reality, or are you just blindly following the headlines? Thanks for joining me on this daily brief, and I'll catch you next time.